Well, good afternoon, everyone. Thanks for tuning in to today's September edition of Market Matters. For those that don't know me, I'm Todd Jones. I'm the Chief Investment Officer for Gratus Capital, and I'm glad you could join us today. It's just a pretty simple agenda for today. We don't have a special topic, so I think this will be maybe a little bit shorter than normal. We usually target somewhere between 20 and 30 minutes for these. But obviously, with a lot of cross currents going on today, and certainly any questions that come in, this may take a little bit longer. So it's a good reminder, if you do have any questions, please feel free to drop those into the chat function of Zoom, and I'll grab those and see if I can address those as they come up. Let's start with the economic update, because this does have a way of framing what asset prices can and will do in the future. And looking at the U.S., because it is still the world's largest economy and one that we all live in, of course, does tend to dominate the direction of where asset markets go globally. What you're looking at here on the screen, I've shown this before. This is actually a very similar picture to last month, where what you're looking at is the U.S. services sector in purple and the manufacturing sector in orange. And just for reference, any number that's above 50 means that those two segments of the economy are in expansion territory, which is generally a positive thing. Any number below 50 means that they're in contraction. And so, clearly you can see there's been a pretty remarkable rebound from COVID. In the services sector in particular, we kind of topped out coming into the beginning of the year, call it November of last year. It had been trending lower, but I do think this kind of flattening out of both the services and manufacturing sectors is really important, because if these were continuing to decline at the rate they had been earlier in the year, then I think the recession question would be really answered. The fact that those are pretty much stabilizing at the levels they are now in expansion territory does still leave open the door for the hoped for soft landing in the economy, but we'll just have to see data points as they come in. Both of these two numbers should be available toward the end of this month, so we'll update you in October as to what September's readings were. Still a mixed decision though, bottom line. On another piece of good news, actually it's good in one sense and maybe not so good in another. The U.S. economy just passed a milestone, recovering fully the number of jobs that were lost from the COVID drawdown. And this is a pretty monumental task, because you can see the very sharp sell-off. About 20 million to 25 million jobs are lost very quickly in 2020, and those have been all gained back. Actually, last month was the first month that we had the number above 152,500,000 jobs in the U.S. economy in total. So that's the good news, is that there's lots of opportunity for employment. The bad news, of course, is that when the number of job openings now is still at record levels. I think there's 2 job openings for every qualified job seeker, which is part of the reason why we're seeing some inflation. And that's where, services sector inflation that we got from the CPI this morning is a little bit troubling. One reason why the markets are having a little bit of a indigestion after the CPI report, because what it means is there's still a job seekers market, not an employer's pricing power market, and so therefore incomes will likely be pretty sticky around these levels, and inflation likely will take a little bit longer to get down to target levels than originally expected. And if I had to net out what the action in today's market's all about, that's exactly it, is that the data underlying the CPI report suggests it's just going to take longer to get down to that below 6% target, which is our target, but nowhere close to the 3%, 2 to 3% target the Fed has outlined. So we've got quite a bit of wood to chop from here. Moving to commodity prices, this is just one commodity, but it's obviously a very important commodity, and this relates to the oil market. And one thing, I did point this out in the 2-minute segment, but I think it's worth mentioning on this program, and that is if you price oil in something that's not a currency that can be created by a government, meaning a paper currency, something like gold tends to be a very stable value over millennia. And all you do is create a ratio. So you just divide the price of energy, $90 a barrel, divided by the current gold price, which is $17.10, I think, as of today. You come up with a ratio, so the percent of crude to the price of gold. and it's currently about 5%. And what you can see is this plotted back through time. And this is really important because obviously economies or governments have the ability to create money, part of which is likely the cause for some of this inflation through all the stimulus packages and rescue packages and such. But what this does is it kind of nullifies that effect of currency creation, pricing things in a constant currency. And so what is this chart, this ratio chart telling us? Well, I've got some comments on here, but essentially, if you price oil in something that's non-fiat, you come up with this ratio. And if you were to have an average level for what the price of oil should be, it should probably be somewhere closer to this 6 level, which it did touch a couple of months ago. So I think this was as of August, right? So back in August, it peaked out at above 6, but now it's back down to 5.1 as of today. And so all that suggests is oil probably shouldn't be going a whole lot lower from here, and that's going to be a little bit problematic for inflation because inflation does need energy prices to come down a little bit to continue to get this momentum in a decline in CPI. But also it does expose us to a little bit of upside risk in oil and energy markets because the 6 is maybe the linear regression or the average, and prices have a tendency to go above and below these linear regressions pretty consistently. So we've just come from a point where we're below it. The way I look at this is, well, maybe we're in for a period of time where we're going to be pricing above it for a little bit, which suggests oil might be very firm around 90 and potentially well into the hundreds. This is a picture. Schwab just put this out the other day, and I thought this was good to pull into this discussion. This is a look at global inflation, and you're going to hear me say the word inflation a lot because that is, as I've mentioned since the start of the year, that is the key variable that asset markets are pricing on right now. Any change, because inflation impacts bond yields impact financial markets, things like stocks or bonds in particular, but also cryptocurrency, other type of more exotic assets. What you'll notice here is this inflation is not a U.S. phenomenon, which is the orange line. This is core CPI. This is not headline. So if you strip out food and energy across all regions of the globe, or the major regions of the globe, this is the core CPI. And what you'll notice is in most regions, it's increasing pretty decently. Actually, the UK has got a much higher core CPI than we do at the moment, which is interesting because they're mainly exposed to Russian energy politics. But the one issue, or the one part of the globe that's not experiencing a lot of inflation right now is China. And there's a few reasons for that. Number one is they've been very aggressive at locking down areas of their country. The no COVID policy continues to be in effect, and they've certainly been locking down large parts of coastal regions that have had COVID outbreaks. That's number one. Number two, though, is that China did not sign on to any Russian sanctions, as most of the Western world did, meaning embargoing energy. So a lot of that crude oil that was supposed to flow west towards Europe and the US from Russia has actually been now flowing eastward towards India, China, and a couple other nations, Australia and Japan. And so energy inflation for them is not a big problem. This dichotomy, though, in inflation does create some friction points, and that's showing up right now in a very strong US dollar versus the rest of the globe. So that's definitely something we have to keep a close eye on, because a strong dollar is good for us as US citizens because it means our import prices will be lower, but it's bad for the rest of the world because a lot of the rest of the world, particularly emerging markets, have priced their debt in US dollars. And if they can't repay their debt easily with their own currency because it's going down, then that becomes a big problem. And that's already starting to show up in a number of fringe countries around the globe. So this does have an impact to our investment strategy as well, meaning that you may recall we reduced our international exposure by half early in the year, and we actually exited all of our emerging market positions in advance of the Russian invasion in February. So it's important to keep an eye on these dynamics, and that's kind of how we're looking at it at the moment. This is that chart y'all are probably really sick of looking at, but I do think it's important because it is the key variable. And so I've plotted since 2021 all of the month-over-month CPI reports that have come out, and these are all annualized numbers. So and this is through today. So actually, I plotted today's. So what you see here, if you're to zoom in, headline CPI came in at 8.3%. The market, which is this little star right here, was expecting 8.1, meaning a more of a steeper decline in inflation. And that 2 basis point difference is, again, what's the problem with markets today. This is the current consensus, and the current consensus still thinks that we're going to be in a pretty linear progression downward in inflation. I'm not so sure that's the case. At this point, it's likely going to be a little less steep of a slope, in which case you can see what was last month, the expected time when we would reach the 6% level was, call it late March of this year, of 2023. Now, what the math suggests, and this is just me calculating a rolling 12-month average. Now the math suggests that we won't reach that below 6% level in inflation and the headline number until somewhere between June and July. So just continuing to push out that date, which is why markets continue to be what I call in the chop zone, meaning just really directionless, but violently up and down until a more firm direction is known about how inflation is going to evolve. One thing we do have to keep in mind now is that the war in Ukraine has been going on since February with the invasion of Ukraine. And the longer this war goes on, the more entrenched the interests get. Certainly, Ukraine has every right to defend themselves. The Russian position, however, is starting to decay. And I think that was the recent story that came out this morning in a New York Times article suggesting that Ukrainians had taken back large parts of the Donbass region. This is the Donbass region was blown up here. This is the area that they've reclaimed more recently. But I fear that the longer this war goes on and the more land that Russia loses, that they will be tempted to do some very nasty things, whether it's continuing to attack the nuclear plant that creates a dirty bomb situation, or something more nefarious. So it is a geopolitical risk that we do need to continue to monitor, because obviously it's still a travesty that Russia is in sovereign territory, but also there are knock-on effects to that, and we do need to have some positions that can offset any negative byproducts or side effects that come out of this continued hot war that's in the eastern part of Europe. And we do, actually. One thing that I pointed out last month, which has been doing, again, quite well during this whole tumultuous period for markets, has been trend following strategies. And on days like today, they tend to do pretty well, because right now the trend in some of those trend following strategies has been to be short a variety of different markets, whether it's commodities or equities or bonds. And that's been working pretty well. So that's something we'll continue to add to. We've actually just recently added to it before the CPI report on Monday, and might even be something we add to additionally. So let me just move on here. So I did present this last month, but I do think it's important to, during these very negative periods for markets, it's important to understand what could go right. And just here are a few things that we still don't have, any consensus around quite yet, but we still have very negative investor sentiment that reversed course a little bit in August, but then now has come right back into a very negative position. And this negative position really just means that, investors are sitting on average, if you use a number of different surveys, a very high level of cash that they wouldn't otherwise be doing. And, at the first sign of improvement or, some resolution in Ukraine, that could be dry powder, if you will, to come back into the markets. Cessation of conflict, we still don't have that. Inflation declining faster than expected. If anything, it's actually been declining a little bit slower than expected. So that's still not something that we can hang our hat on at the moment. And then a compromised U.S. tax reform bill. Still, I think some of the details have yet to be released on that, and finalization of regulations, but that's something that is in the final approvals process, if not finalization already. So just 2 out of 4. There's a few other things, of course. One that I mentioned last month was the buybacks, that we're entering a period for stock buybacks that typically is very sizable, and in the face of what's likely to be a tax on buybacks next year, a lot of companies are indicating they could accelerate their buyback program, particularly with markets down this year, into 2022, which would provide a very nice floor for stocks at certain points. We'll see how this all impacts our investment outlook. And what you'll notice is here, not a lot has changed. I mean, there's definitely some things that we've done more recently that still speak to some of these ratings, but I'll just review these more briefly. We have had, as small cap and mid cap companies have sold off, we have upgraded these positions. Actually, we're awaiting some final approvals through the investment committee to look at a small cap strategy. But by and large, we're still fairly neutral on equities as we continue to be in the chop zone, as I call it. Developed markets, we recall we downgraded these, specifically emerging markets. Those have been trading very weak relative to U.S. companies. And just for reference, you'll see in a moment that the emerging market index is down close to 20% for the year through yesterday. U.S. companies are down 13 or 14, something like that, and that 6 to 7% difference is only continuing to grow. On the bond side, we have been very cautious on bonds, and as I'll show in a minute, we have been rotating capital out of bonds at a number of different points along the way in favor of alternatives, which has been, I think, a good strategy to execute over time. But also more recently, we've been positioning our accounts to be much more shorter term oriented in duration versus our index, because now with the yield curve where it is, it's currently inverted, which means that the shorter term interest rate markets are yielding higher than longer term markets. We're actually getting paid a little bit more to have shorter term exposure than long term exposure. And we can talk a little bit more about why that might be the case if anyone's interested, but just something that I would point out as an action that we've been very decisive on more recently. And then of course, what did we do with the capital that we reduced from bonds? We added it to alternatives, which on a relative basis, relative to bonds, have performed a lot better this year, which again, just speaks to some of the active approaches that we're implementing. Not to say that, accounts are positive this year. I don't want to, give off that idea, because that would be a monumental feat of portfolio construction if we could have pulled that off so far this year. Some themes that run through, and these look a little similar, but I have made some updates here. And maybe the biggest one, this was a caution sign last month, and now I'm putting in a danger sign, because there is a danger that with inflation staying as high as it is, the bond market doesn't act the way that the Fed wants it to. And that was our thinking, our calculus around the changes that we decided to make in advance of the more recent CPI print this week, was that we have to now account for the fact that bond yields are still priced lower than they should be. And if we think that bond yields will be rising sharply over time, then we need to adjust our positioning so that we don't, have substantial capital losses when that occurs. Because, again, bonds are like a seesaw where you have income, interest rates on one side and bond principal on the other side. As interest rates rise, the seesaw dips, right? So prices go down. As yields fall, then prices rise. We're currently in one of those situations where bond yields are rising and prices are falling. And that's not necessarily a bad setup per se, because in the 1970s would suggest that if you're starting at a decent income point, like 5 or 6%, then yields rising from 5 to 7 to 8%, if it's done slowly over a number of years, actually isn't super impactful to your return or performance. The problem with this year, and why 2022 will likely be, if bonds stay around these levels through the end of the year, will likely be the worst year for bonds in history that bonds have been recorded, is because we started the year at such a low level. And that was something we flagged in January, of course, and well into early mid last year. But the 10-year bond yield started the year, I believe it was at 1.5%. 10-year bond yields right now are at 3.5%. So haven't quite doubled, but that's a lot of price movement that has to occur to adjust current bonds to reflect that existing market interest rate. And so that's really where we see some of the dangers that if bonds continue to be mispriced and inflation stays higher for longer, then we need to make sure we're continuing to get more conservative in the bond sleeve in advance of those changes. That said, I do want to point out, there are better opportunities on the horizon. Certainly as bond yields move up, that means our starting point for getting exposure to yield gets better. So a lot of you probably noticed that, some of the money market funds that you have exposure to are now starting to pay, much better rates than they were 6 months ago. And that's certainly something we should welcome, no question. But we're still not very excited about some of the more risky parts of the bond market quite yet. High yield, preferred stock, CLOs, these things that I see out there in some other portfolios that have just gotten absolutely hammered this year. And actually, the worst one of all is 20-year Treasury bonds are down, if you can believe it, about 28% this year, which is really unbelievable to think about a loss like that in a bond portfolio. But I think with the changes we're making and have made over the last 6 to 12 months, that kind of outcome isn't anywhere in the cards. These transition phases, this is going to be probably a little bit frustrating for some people, but transition phases in these markets can take some time. Like I mentioned, it's why I think it's important to keep our eye on when CPI is going to get below 6%. I just showed you that, using just the current math that's in front of us, we're likely to get that to 6% or below number by middle of next year. So a lot can happen, of course, between now and then, which is why we have to take a patient approach, continue to be conservative, have some cash on the sidelines, and then having some exposure to alternative strategies, whether it be public or private, that actually are set up as absolute return strategies that can generate return based on some of the market volatility that's in front of us. So here's a look at year-to-date picture at global stocks. And I definitely wanted to point this out because there's been a few shifts that have occurred this year, even since the end of last quarter. The S&P, again, finds itself the cleanest dirty shirt, if you will, where it's down 13.5% through yesterday. Today, obviously, it's going to be down a little bit more than that, depending on where we settle out. Small caps haven't sold off a lot, which is really good to see because it means there's still support for the smaller component of companies, which generally tends to lead markets rallies out of more challenging conditions. Now you can see everything else: Chinese market, emerging markets, and developed international. This is actually developed international. This means Europe, Japan, and Australia. And Europe is certainly experiencing a very significant amount of pain in their markets at the moment. Germany, in particular, because investors realize those companies are uniquely exposed to Russian issues with energy, and it's been a really challenging situation for many German industrial companies. So, again, we exited our EM position back here. We reduced our international developed position, I think, right around here in April or so, and then continue to have a vast majority of our capital in large cap U.S., which in this case would be the S&P index. But again, we are in, and again, some of the narrative does tend to fit in where we are at the moment. I found this great series from JP Morgan, which just shows the returns. And this is a midterm election year, so obviously this is not a presidential election year. This is a midterm year. And what do you find that typically characterize midterm election years? Well, it's kind of intuitive, but maybe not entirely. But since 1940, midterm election years have registered the lowest average annual return. So if you average up all of the midterm years since 1940, the average return for any year in that series has been 5% or 5.4. And they've also come with the highest level of volatility. Now, this is inclusive of 2022 as well. But it is interesting that in every other midterm election year, high volatility has accompanied this lower return set. It just means that we need to be a little bit more conservative and careful with our positionings, and then wait to take decisive action on the other side of this. Because leading up to the election day, it's day zero, it's been a bit of a mixed bag. So you can see how return has progressed over the years. There's a lot of spaghetti lines. So every midterm election year, This actually goes back only to I think it's 1982. So I need to make sure I adjust this title here, but just shows you the progression of each of these years of return, minus 100 days out to election day and then 100 days after. And it looks like 9 times out of 10, your return has been positive after election day, 100 days out, so through the end of the year. This is why you can't necessarily abandon equities at this point, because what history is telling us is that the volatility is just something we need to look through, and that if we stick with it, that returns are generally going to be pretty positive on the other side after election day. Fixed income this is the chart of fixed income year to date, and I've just reflected a few indexes on here. And if I were to have stripped out the labels here, you would have all probably thought these were equity indexes. But we're in one of these rare years. Again, this is almost unprecedented in nature, where equity returns are almost the exact same, and from a negative perspective, as bonds. Because you can see here the aggregate bond index that we're measuring against is down 12%. High yield is right on top of that, which is really interesting because it's not really pulling in any default risk premiums quite yet, because we haven't hit a recession. But emerging markets are down over 21%. Bonds, we've never liked EM bonds. Not never, but we've not had any great exposure to EM bonds for the better part of the last 10 plus years. And I don't really see a reason to get too active there at the moment. Yields, of course, will make us attracted to those categories. And currently with EM bonds at 6 or 7%, that's just not enough compensation to look at as an asset category. And this is what I was telling you, that the TLT, this is a long treasury, is down 27.5%. That is a catastrophic outcome for a fixed income portfolio, and one that we've been flagging for quite some time. We have no long duration exposure in our portfolio. And I just wanted to show or share with everybody, what's more or less happened. What it shows you is the shape of the yield curve at various points in time. So in January, I was referring to the 1 month treasury bond was at, call it 5 basis points. Now in September, this is as of last Monday, I think, or September 7th. As of September 7th now, the 1 year treasury bond is yielding 2.4%. That's a massive move from 5 basis points to 2.4. You can see what other strike prices or tenors along the yield curve have done. And this is something that, obviously after today will change a little bit as well too, because there's been a lot of shifting going on in bond markets. But this is something that, we've been very cognizant of and aware of. Certainly don't want to be positioning out here because there's a lot of risk with lower yields that you can get significant price declines when yields change. So for right now, we've been migrating most of our bond capital of what remains actually in this shorter term range, so that you have a maturity on the horizon to contain the price essentially. And then this just shows a picture of real interest rates. I shared this on the 2 Minutes podcast, but I definitely want to make sure we all understand this, and that this shows what they refer to as 10-year real yields. So if you take the 10-year treasury bond and then subtract the consumer price index from that, it's either positive or negative. And currently we're in a negative yield situation. Negative yields, as you can see over the long arc of history, are generally not sustainable for forever. And there's a reason for that, because it's a big tax on the economy and savers, for that matter, to have negative real yields. And so generally we go into periods in advance of recessions where yields get very negative in real terms, and then on the other side of that they pop back up to positive. The only problem with that is that either the CPI has to come down pretty quickly, or treasury yields have to rise pretty quickly to get us to that zero real yield tenor or real yield situation in 10-year bonds. So it's probably going to be a combination of both to get us there. But I guess all that is to say, we still have some wood to get to that zero real yield situation. And then I did show this, maybe it was a few months ago or 3 or 4 months ago, But I did want to highlight, these are all the changes we've made in accounts over the last 18 months. These are all investment committee decisions, so there's nothing super specific in here that you'll be able to pull out per se. But each of these changes or transitions refers to an action that we've been taking in advance of what we saw would be, potentially issues on the horizon. And speaking to the bond issue, I actually flagged this in our investment committee back in 2021, where I was just suggesting that low yields could not be sustained forever, and that for some of you, that meant that notching up your risk exposure to equities was the right answer, because if we could foresee that bond yields would be challenged, then your capital would be better treated, particularly in 21 in equity markets. And I know a lot of clients took that recommendation, which we're really happy about. And then in July of that same year of 21, we reduced bonds in favor of adding to liquid or private alternative strategies. Generally, these are incremental shifts, so 5 to 10% of capital in one shift, but nonetheless, a pretty meaningful migration. And then in this year, in March, we did the same thing again. So reducing bonds down to the lowest level we've ever had bonds in a 60-40 portfolio. Just for reference, where 60% is in stocks. Right now, our target level for bonds that, again, is short-term oriented is 17%. In the old days, maybe back in 2010, that number was 40% in bonds. And then in 2015, it was probably 20 or 25. Now we're at 17. And probably not going to go a whole lot lower from there, because we can contain the risk with what remains in shorter duration positions. But nonetheless, these are all the actions we've taken to mitigate what we saw would be potentially challenging conditions on the horizon. And then more recently, at the beginning of this week, we shifted from a 10% in our fixed income portfolio. We shifted from a 10% ultra short duration bond ETF position to more than double that at 25%. And what that did was it took the average interest rate exposure down from 5 years down to below 4. It's at 3 and some change now. So that was a substantial move in advance of potentially what could be a pretty negative outcome. And I think that's certainly worked in our favor, but we'll certainly have in the back of our mind a level that moving out of a short duration position back into more normal interest rate exposure positions might be something appropriate to do. And we're thinking, that level tends to be somewhere between 5 to 6% in bond index yields. So finally, I just wanted and again, if you have any questions, feel free to drop those into the chat function, and then I can take them as they come in. But I know I sound like a broken record here, but we still continue to favor stocks over bonds, continuing to think that sideways markets are in front of us. That doesn't necessarily mean that the bottom's going to fall out of the equity market. And in most cases, like in the case of our dividend strategy, the yield is much better than the bond market actually right now, at about 3.5% or so. We still continue to favor alternative strategies over bonds. And I guess what I mean by that, if we're sourcing capital from the bond segment of our accounts, private strategies that deal with income orientation are pretty well suited in the current environment. And then, final thing is here, ultra short-term bond funds versus money markets or cash. This just speaks to the shifts we just made, but with ultra short-term yields now having risen up pretty significantly, we feel like we're finally getting compensated pretty decently to take on actually not as much interest rate sensitivity and just sit in some of those ultra short positions with very minimal interest rate exposure is our preferred place to stay at the moment. And then, of course, private markets are a whole different animal, lots of stuff to do there. And, we certainly are very active in those markets. So we welcome any discussions on that in the future. Let me just see, there is one that came in to the chat function that says, if inflation isn't below 6% until June, July, is the expectation that markets chop until then, or might markets move in advance of that if that doesn't keep pushing out? It's a great question because, as you probably heard me say, markets are forward-looking. So, and they look out somewhere between 9 to 12 months. So again, if we're, in September and, we get to below 6 by July of next year, it's about nine months out or so, we would be right around that point where markets could start to reflect that. I think what would be the interesting, or what we're going to get some of our tell from, is some of the sectors that are moving within the equity markets. So far this year, if you look at sector returns by S&P, what's done really well has been energy, of course, up 30 or 40%. Utility markets, or utility stocks, which are up 8%, as are typically very conservative. Healthcare, which is actually only down marginally, and then everything else, meaning consumer staples, have held up well. But things like technology, industrials, materials, and so on, communication services have all gotten pretty banged up. And so I think what we'll be looking for is a continued deceleration within the CPI to a trend level that would get us to that level relatively quickly, but also seeing some shifts or changes in the sector's performance that would help inform whether or not this move down to 6% is going to actually happen or not. Because if we get inflation trending down to a lower level, theoretically, energy should be moving lower along with it. Energy stocks, by extension, should start to be moving lower as well. So it's actually a good thing that energy wouldn't be very strong, because that would mean inflation could potentially be coming down. But thank you for that question. That's why I want to update that chart pretty regularly in these Market Matters sessions. But I do appreciate you all spending the time this afternoon to listen to our take on the markets. I certainly understand this has been a very challenging period for a lot of people and a lot of strategies. And we're here to certainly answer any questions you might have. And we're certainly putting our best effort forward to get out in front of what's likely to be a choppy market environment for the foreseeable future.